Hi, welcome back, everyone. We'll now hear from Winnie Tan, SVP of Sustainability from Great Eastern, Lee Takaki, Ethics and Environmental Manager of Prudential Insurance Company Singapore, as they discuss the insurance industry's role in our shift towards a more sustainable world and look at how insurance players can remain competitive in this space through green initiatives and innovations. Moderating the dialogue will be Hugh Terry, founder of the Digital Insurer. During the session, please feel free to put any questions you have for the panel in the Q&A window, and we'll address these live during the session. Without further ado, I'll now hand the time over to the panel.
Yeah, thanks Florence, for the intro, and welcome everyone. Hope you've had a good lunch, not feeling too sleepy, ready to go on what is a very, very interesting topic, right? Sort of safeguarding this journey to a sustainable future. And we've got two fantastic panelists here, and I think we'll start by actually asking them just to introduce themselves and also just sharing a little bit their career journey and how they've sort of ended up getting interested and involved professionally in this topic. So maybe Winnie, you could go first on that.
Hi, everyone. Hello, good evening, good afternoon, good evening, depending on the time zone that you are. My name is Winnie Tan. I'm the Senior Vice President for Sustainability at Great Eastern. We are a predominantly life insurance company with a small segment of business in general insurance. And I've joined the company not that long ago, about 8 months ago. It's a newly created role in sustainability, which I think talks about how important this topic has become in both its financial and non-financial impact to companies and particularly for financial institutions. Prior to this, I had spent about 15 years in various roles across Standard Chartered Bank. My last role was actually the regional head for sustainability in ASEAN and South Asia. So we had a a portfolio that was across basically the emerging markets as a British-based bank as Standard Chartered. And it really showed deeply how difficult the transition and how complex the issues were. And I think that's actually the considerations that we keep thinking about today as well. It doesn't matter whether you're an asset manager, asset owner, an insurer or a bank. But I think that really shows the work that needs to be done in a very collaborative manner.
Yeah, thanks, Winnie. And that's it's interesting, as you know, I guess your banking experience as well. We will be able to explore a little bit the contrast that you see between the insurance sector and the banking sector, although obviously we're focusing a little bit on the insurance side today. I think it'd be good to get your experience on that as well. Yeah, Lee, welcome. Let's hear from you as well.
Thanks, Hugh, and thanks everyone for having us here today. So I've been with Prudential for a couple of years now, and that's a little bit shorter than the time that we've actually had a dedicated ESG function. I started out as a part of the ethics team, and has recently spun off to be its own thing just because of how the space is evolving. As everyone knows, we're getting more and more attention from this, not only from consumers, but from our regulators as well and our other business partners. So we want to make sure that we have a separate, discrete and dedicated function where we can coordinate everything that the organization has been doing and to make sure that we stay on target and encourage everyone to do the same. Personally, my sustainability journey actually started for a while and then had a brief interruption. I actually went to my undergraduate degree is in environmental science, but that was way back earlier in this millennium. And in the intervening time, I kind of departed and did some other things just because I think back then the sustainability space isn't really where it is right now. So it's nice to be able to come back to this, to use my academic teaching, my learning, and actually apply it, and to see that there's so much support and impetus in this space now.
Yeah, so I guess you were involved in the early days, almost before it was viable for people to build their careers, right? And now coming back, that's really good. All right, what I'm going to do is share a few slides. We'll use some slides as we go through, not too many, to sort of help us navigate the discussion as well. So I'll bring these up. And I guess the first thing I wanted to do really was just go through how we saw the agenda really for today and what we've planned for you. So really sort of, I guess, three main sections here, sort of framing the topic. And I've pulled together 3 or 4 slides just to talk you through some of the areas. And then we've got sort of two main discussion areas really that we wanted to look at. So one was meeting the goals of moving to net zero, and the other was actually looking at more through changes in consumer behaviours, aspirations, what they're looking for from insurance companies now through that lens of sustainability as well. Please do ask questions. I'm sure you know how the question feature works in Zoom. It's there in front of you. You just click on it and put a question in. That would be very useful because we've got plenty of time to take into account your questions that come in, and also you may come up with some other topics that we've kind of allowed for in the last section as well. So either, if we have a lot of questions, we'll move into those areas. Otherwise, we'll wrap up. So we've got quite flexible on timing. I think we're sort of aiming to run the session up to around 45 minutes or in total, but that'll be sort of plus or minus, I think, a little bit according to how the discussion goes. So do give us your questions as we go along and thoughts. This is an area where there's still a lot of learning going on, right? So it's not an area with a fixed agenda. It's an area where I think we can all contribute. And I suppose that sort of gives me an opportunity just to sort of introduce myself, because I'm certainly not a sustainability expert. My background is in insurance, actuary by profession. I've been in Singapore for 20 odd years. And during that time, I've essentially done things a little bit more entrepreneurially, run alongside the insurance industry. And the thing that particularly sort of excites me, gets me up in the morning, is the impact of technology on the insurance industry. Now, there is some overlap, of course, with technology and the sustainability agenda. And I think hopefully, like everyone else who's on this session today, if you're not an expert, you've probably read around the subject a little bit, maybe high level, maybe in depth. You've probably got some views as well. So I think we should all treat this as a little bit of a learning and knowledge sharing exercise today, and looking forward to sort of, I guess, our panelists' contributions, but also any contributions you want to make as well. So the slides I pulled together really were just trying to be a good moderator, getting up to bit to speed on this subject in the short time available. So I sort of did a little bit of research, and then starting with this quote, which is from Thomas Burbell, who's the group CEO of AXA. He's been in position for probably 6 or 7 years now. And this quote is taken from a summit a few years ago as well. And the reason I put it up there is just to remind us, I guess more broadly, how bad +4 is going to be for all of us personally, right? I mean, this is going to be a bad world if we get there. But this comment here particularly just brings to home, if we do end up in that scenario, business from an insurance perspective is not going to be anything like it was before, because so many risks are essentially going to become uninsurable. The uncertainties in the world will also make some investments unviable as well. So there is an urgency to this, and I think it is definitely the case that I personally, as an outside observer, have seen this quickening in the pace that we need to take over the last couple of years. And I think coming out of the pandemic, I think now probably we're starting to focus and refocus back on this as with an understanding that these are the types of things, if we don't do anything about, are going to really, really hit us very, very hard. And I think it's really good to see what insurers have already been doing as well. And I'm sure our panelists will go into that in a lot more detail as well. So I picked out this, which is the Net Zero Insurance Alliance. It was launched just last year. It has 20 insurers. It's a little bit more focused, just from an outside-in perspective, from the sort of P&C players, because it's focused a little bit more on commitments that they've made as a collective around transitioning their underwriting portfolios to net zero by 2050. And this really means starting to make choices about who we're going to do business with as an industry, and setting standards that say, if you do not meet those standards of sustainability, we will not insure your underlying risks as well. And there are quite a number of insurers, and I picked out 3 here. These are all public kind of references that are being made, where companies are making commitments, right? And again, I'm emphasizing this is on the P&C side. So Aviva is going to be stopping, or has stopped, ensuring companies are generating more than 5% of revenues from thermal coal or unconventional fossil fuels. Zurich making a similar announcement with mining, with some slightly different metrics. And then you've got Allianz saying that by 2025, it's going to have a robust net zero requirement from its customers and hydrocarbon producers as well. And I think it's really important, this, and let's not underestimate how that can have an impact, right? Because you know, the industries, the hydrocarbon industries, have massive infrastructures that do have risks that do need to be insured. So the insurers here actually will make a difference, provided they act in concert together to help us move along as well. So I think that's really, really good. I wasn't fully aware of that, so I was really quite encouraged about this. And then the last reference I've got here just in the slides is actually around a UN report that was done a couple of years ago, and we'll provide some QR codes at the end if you're interested in getting into this in more detail. But this is around the sort of UN principles for sustainable insurance, and it's a framework, if you like, of which analysis has been done. And I won't go into the details because I don't think I'm really qualified to do that. But the main takeaway, I think, is around these three buckets of risk that we've got here in these principles: the sort of physical risk issues, which involves looking at geographies and understanding where insurance may fail under certain scenarios and climate scenarios and what the impact would be. The transition risks, which are the ones that say, okay, what's going to happen to insurance demand as we move into this net zero environment. And then the last risk, the risk that we always live with, is litigation risk, and how that may differ in this future as well. So I think before we move into the first of the sort of two main discussion points, maybe we can just dwell on the UN principles, and maybe we can just reflect, and maybe you guys have got some comments to build on some of the slides that I just presented there. I think maybe Lee, if you kick off on this one.
Sure, and I think this is something we'll probably get into a little more detail as we go along. But as mentioned, you know, coming from a life insurance and health insurance lens, we're just getting into the physical risk side of things. I think it's a lot, not necessarily more straightforward, but I think there's a little bit more of an established approach to commercial insurance when it comes to physical risk. So what we're looking into in the future is a little more research, location-specific research on how these effects under different climate scenarios will impact things like morbidity and mortality, and you know, how we'll have to respond as a life insurer, and also, you know, what role we can play to provide coverage for people in these different climate scenarios, and hopefully will be orderly and just, and everything will be fine. But at the same time, keeping in mind that things will not possibly be orderly and might go by the wayside as well. So mostly we're focused on transition risks. And that has to do a lot with the way that we manage our assets, and you know, fulfill a role as an asset manager and asset owner, making sure that we're leading the way and also encouraging other people to join us as well as we move forward.
And maybe Winnie, you can pick up from that.
Yep. And then I think what Lee says is absolutely right. But I think just to set context, in case we have audience who are not really fully understanding the role of insurance. Basically, as a life insurer, which Great Eastern predominantly is as well, you take premiums, right, from all your clients, and you have essentially a balance sheet, which you then reinvest in, and hopefully you will get the sort of returns and in order to offset your risk premiums and to be able to remain solvent and also very successful in case of a payout for your clients. So basically, it's two sides of the books that we're looking at: the liabilities and how we underwrite, and then how we manage our balance sheet investment. So Lee has very rightly pointed out the link between mortality and morbidity with climate risk is not quite concretely set out, but we all know that there's going to be a huge impact because climate change changes a lot of physical risk. And we will be seeing this, especially for life insurance, where coverage for our clients, imagine if you bought a medical and you bought a life insurance from us, you'll be looking at it for the next 20, 30, 40 years perhaps. This is the amount of time that we need to be able to protect you, pay out as you're required and you deserve, and also make sure that our balance sheet is healthy and providing the returns that we plan for. So think about it, the asset pricing, the sort of equities, the bonds, the different asset classes that we're investing in. We know that climate change from both transition and physical risk would have impact on the way companies operate. A company who would be very profitable right now today might look quite different if it has to pay, say, carbon taxes. It has to think about its supply chain, the materials that it uses, how it actually impacts the environment. When these externalities are included in the way they think about their profitability, it could be a very different picture. So it could be about different investor demand. It could be about whether their industry was going to be changing, whether they were equipped to face the so-called transitional risks as we sort of move into the whole global so-called like low carbon economy. So I think in this particular case, yes, we have yet to find out as an industry how we exactly do that, but the relationship is very clear that we are prepared and we see the financial and non-financial impact of climate risk, and this is something that we're preparing for. Maybe just a little piece about general insurance, which really looks more at like property and casualty for say companies that we work with, buildings, property, marine, cargo hull, and etc. More industry-based and corporate clients. The physical risk is very real. Think about what just happened in Seoul just the last week. The crazy floods and the waters rising. You could hardly see the taxis and the cars because they were covered by the water. The water has gone into the subways. It has gone into train stations, etc. The sort of infrastructure damage is incredible, and there is no city that has been planned to cope with such amount of water or amount of rain that could come down in a short matter of hours or just days. So these are the real considerations that we need to look at, because the extreme weather events, whether it's rain, whether it's droughts, whether it's like, typhoons or also other extreme weathers, they are becoming more frequent and actually more extreme. It is actually worse. So these are the sort of things that we are considering very importantly, and putting through different layers or ways of risk mitigation or risk assessment and mitigation. Obviously, then I'll have to go into this other topic about the challenges that we face as an industry around the right sort of information, data, references that we can get. But these are just some of the things we have to work through.
Yeah, thanks. And yeah, it's good to have that general insurance side as well, because that does get to some of these physical risks very, very explicitly. I'm sure we'll come back to those as well. All right, let's get going and sort of move into the first sort of main discussion area around sort of, what can we do as an industry to meet these goals of moving to net zero by 2050? The aim is to say, let's limit the increase in temperatures to about 1.5 degrees C, right? So no, we're already at a point where we're saying we're limiting, right? So we're not in a point where we're saying there's no change. We can see and feel that, I think, around us as well. And these questions here are actually ones I think we'll go through in turn to greater or lesser degree. And then if I see any other questions that are relevant that you guys want to ask, I'll ask those as well as we go through. So let's just start more generally, and maybe Winnie, you can pick up again. It's just that first question: how are insurers aligning to these global objectives?
So I think there are a couple of different ways we do that. So we've spoken a little bit about what we do with our investments. I think as asset owners and some of the insurers as asset managers as well, we're definitely taking active steps. But when you think about taking active step in integrating ESG into your investment portfolio, there's a whole spectrum of things that you can do. Is it around excluding certain investments and asset or investment managers or asset categories because it doesn't have the right ratings? Is it also putting it into limitations, or swinging to sort of the other extreme of the spectrum is about investing for impact? But considering as well, you need to be investing for returns, and how do you then balance all the different considerations? One of the very unique features around, especially I think for investors and insurers and financial institutions who operate in Asia, sometimes you may have requirements that you need to put money or investments into local assets or bonds, for example. And when you think about it from, say, even just from a banking banking example, you'll be thinking about, yes, we need to promote economic growth. We need to think about financing and channeling the capital to the right places. But then how do we actually execute that? The similarity is very similar. There's a high similarity between banking and insurance because these are very complex issues. And when you want to think about financial returns, commercial returns for your financial institution as an organization and as a business, opposed to the sort of impact that you want to finance for and you want to invest in. Sometimes there are no straight answers or there are no simple answers for you to think about. But also as an insurer, when you think about the underwriting and insurance business, I think climate change and climate risk is something we want to think about, but also very importantly is about the social outcome. Are we providing access to the underinsured or people who may not have access to the protection that we can offer? And I think this is where insurance also has a very key role to play. For example, how do you reach out to groups who are underinsured and may need protection but may not be able to afford that? There are many solutions in the markets and it's been done very differently across regions, but there are probably solutions like microinsurance. Something that was done last year was to extend insurance out to primary caregivers who have children who have special needs. So instead of, say, protecting the children directly, we're protecting their parents or caregivers so that they can maintain the ability to take care of them. You can think about also like different ways that an example would be like in Singapore, you have the DPS scheme. In Malaysia, you have what you call the B40, which is population that's so-called under the poverty line. There are national schemes to provide protection for this. Great Eastern is part of that in both countries. But the thing is, what else can you do and how else can you do better? And how else do you then think about it from a commercial sense so that you can structure the right products and solutions, but yet think about how the risk transfer to, say, reinsurers, how does it sit in your company when you think about your company's earnings, and if you're a listed entity, how do you give credit and also explain to your investors? I think these are all multifaceted considerations that we have on a day-to-day.
Yeah, thanks. There was a lot in there. I think what I'm going to do is I'm going to tease around on what was actually that second question, which was on the investment side. And maybe Lee, you could come in and sort of build around investment, some of the stuff you're seeing. And actually, I want to ask the question to both of you, but ask it to you firstly, which is, we've seen that insurers are saying on the risk side, look, we're not going to do business with companies unless they meet certain standards. Is that where we're going to go on the investment side? And if we are, how are we going to get there? Is it going to be individual companies that make that commitment, or are they going to wait for others to kind of push them into making those commitments?
I think there's two schools of thought that don't necessarily have to be exclusionary. One is, divestment, right? If a company is not meeting your standards, then you just sever ties. But the other is, what kind of influence do we have as an investor? What can we do to encourage those companies to take a look at their operations and their business model and see how they can maybe get on the path to a transition, which is why things like the Net Zero Asset Owners Alliance and all these other kind of coalitions of investors can come together. They can pool all of our considerable assets that we have that might be invested in these companies and say, listen, we're concerned as shareholders, and we would like you to take action on it. If we completely divest from those companies, we don't have those options anymore. So like I said, you don't necessarily need to do one or the other. It can be kind of a measured approach, incorporating both. But at the same time, I think it's just important to recognize the role that our organizations play, and what should we be doing, how we should be leading the way, what kind of example we should be setting across the industry. And also, how are we meeting our customers' expectations of what we're doing with, with their trust and with their policies as well.
Yeah, and you mentioned this Net Zero Asset Owners Association, right, or Alliance, and I haven't picked up on that. Is there any more info you can give on that?
Broadly speaking, you spoke about the Net Zero Insurers Alliance, and along the same lines, and around COP26. It was convened with just some of the major players across the world who are committed by 2050 to making sure that their assets meet net zero requirements, which is a huge undertaking. And 2050 might seem like a ways away, but in order to achieve that goal and to make sure that their their investments are net zero, meaning carbon in, carbon out is zero, is huge, especially because of the way, as everyone's aware, how our global energy, where all that comes from, where the trading goes, and everything that's involved. The fact that we don't have, as it stands right now, the infrastructure to completely move away from fossil fuels. These are things that we need to be considering. The fact that transitioning should have started 10 or 20 years ago, but they say that the second best time to do something is today. So what can we do with that influence? And one company alone might have a little bit, but if we pool everything together and pose a significant coalition of groups, what can we do? How can we leverage that? How can we come together on a unified front and say this is what we expect?
Yeah, Winnie, what's your additional thoughts on this investment topic?
I think the challenge, as with all resources, you need to get the right amount to the right place at the right time. And it almost never happens. It never happens with rain for agriculture. It never happens with financing in this case, and for every other possible scenario in your personal and career life. But that's actually what I think this coalition needs to do. And I think this is where the concerted effort of the industry is needed. And personally, I'm a huge fan of regulation in that sense, because I feel that regulation, when set in the right tone and the right pace in the correct context, it helps to accelerate certain changes. Maybe some people, they don't have a choice, they do it. Some people are already on the bandwagon, but it sort of equalizes and sets a minimum baseline where, for example, MAS had their requirements for environmental risk management guidelines in Malaysia, and Bank Negara has issued their climate change principles for transition. So I think these are good so-called equalizers to balance out. It also helps sort of solve some of the industry issues around, say, access for information, standardizing norms, standardizing the way we talk about it, so that you can compare things that's like for like. I think one of the challenges that we all have as financial institutions is you don't have correct information or data to be able to compare, say, this company A to B in the terms of their enterprise value, their asset value forecast in the future. So it's having some of this standardization really, really helps. And I think another thing that's really, really useful is obviously being able to work as a coalition. So whether it's a net zero investment insurance association or asset owner or asset manager, or for banks, for example, I think what this gives you is the strength as a group to be able to say, we shouldn't have banks, or we shouldn't have insurers who are saying that they will bank or insure the last fossil fuel company, for example, because that would actually be a very wise business strategy for an insurer or a bank if they weren't going to be here for the next 100 years. They could just say, we will just insure or underwrite or lend money to the last, say, fossil fuel or coal company that didn't have a transition plan. And they would, to be honest, be raking in loads of money in the short term. But that's also because they're not thinking about the future. They're not thinking responsibly about the larger context. So I think having a coalition to sort of move this forward is really useful, especially when, as an investment manager or asset owner, sometimes you own assets through different asset classes and in sort of like little bits and bobs, if you like. And what happens is you need a coalition to be able to be impactful and to be able to exercise a change.
Yeah, and that's I think that's quite insightful, right? If you work through, coalitions are good, but they also have some limits, right? And hence the need for regulation. So in a sense, we're saying, well, we're probably hoping that the MAS, Bank Negara, other regulators will actually pick up on this sooner rather than later, right? Because it will help to make sure that it's a level playing field and everyone knows that they're going forward against actually what are effectively national and global objectives, aren't they? So it's kind of putting in the scaffolding, if you like, to make sure that this is something that's achievable. And as you quite rightly say, there's also then the ability to kind of invest a bit more collectively in some of the data gathering, the assessment side, which if any one insurer or bank was trying to do could be prohibitive as well, right?
But it also leads to another point, which is hugely important. It helps to scale up the learning and the training of people who are actually going to be doing these jobs. So if you think about it, the typical underwriter or the actuary individual, there are actually new categories around climate risks that you need to think about. In that sense, do we have the people who have the right skills and expertise to do it right now in the market? The answer would be yes and no. So I think being able to sort of scale up this training to create the environment for that is very important. And I think in this case, there's also, I think, the role of industry associations to sort of help build this at a pace that's fast enough.
Yeah, I mean, our business, the business I run focuses very much on learning and development on digital insurance, actually, which is another important area where new skills are needed and new insights. So certainly I can see the resonance of that, and actually the need to help all of us get up to speed in this area. So it's almost like these two things going on at the same time, right? The need to get further and further into the regulation side, but also the need for the skill side to be there in terms of how do you do these assessments, what are we looking at, and the key factors. I guess this is your sort of academic background a little bit, Lee, right? Going back to school and back to uni. And what are your thoughts on this, on the sort of the need for regulations?
Yeah, unfortunately, we can't expect everyone and corporations to be altruistic when it comes to these things. As Winnie mentioned, with several facets, we do have to provide returns on investment. We do have to make sure that we're running sustainable businesses. And the temptation to engage in unsustainable practices is always there. I mean, as we've seen recently too, with supply chain shortages because of the war in Ukraine, we're seeing migrations back to things, in the wrong direction, an increase in the use of coal because of disruption of gas and natural gas and oil. So it can be very tempting to give into that and say, this is the way that things are right now. And without an external impetus, without external encouragement or straight out regulation, I really don't think that we can expect everyone across the world to jump in the line. So fortunately, especially locally here, we have a regulator that's very aware of these things and has very good communication on these things, very good resources, and is always assisting us at every turn to step in the right direction. I mean, by hook or by crook, but at the same time, the carrot first, right? Encouraging us to take these preventative steps and to get out in front and do what's needed.
Yeah. And what have you seen just your companies themselves do in terms of more the internal focus, right? In terms of the companies that, insurers themselves taking outside the risk and the underwriting, the asset side. What are your companies doing internally to move towards net zero? Have you seen things happening there as well?
You're just talking about net zero just on the climate side?
Yeah, and sustainability agendas within organizations. Do you have clear cheerleaders? Have you changed policies and things like that?
Fortunately, our organization we have support on all sides. So getting buy-in is there's no need for us to actually work hard to get buy-in. Everyone is supportive of this, and they realize that we're playing a role and it needs to be fulfilled, and we need to bring to bear everything that we have with us to take a step in the right direction. So with net zero, we started a few years ago with taking a good look at our investment portfolio. I mean, the first step with anything is measurement to see where we stand at, and then figure out where we need to go, and then just set aggressive targets and make sure we're taking those incremental steps in that direction.
Yeah. And what about you, Winnie? What have you seen?
So I think for a company like Prudential, I think they're definitely ahead in sort of called the life cycle or the curve in the whole sustainability journey. So for Great Eastern, we have, this particular role that I have in the team is started basically 8 months ago. So what we've done, and the fact that by virtue of the fact that we're an insurance company, the fact that we take risk really seriously in both as a risk carrier, as an asset manager, asset owner rather, it was about first identifying, like Lee has mentioned, but also very importantly, structuring and making tweaks to our risk management framework so that it actually is capable of looking at climate risk and being able to manage that. So there are very fundamental things around including climate risk and sustainability ESG into our enterprise risk management, creating different policies and frameworks in order to support that. And I think what's really important is risk management is as effective as the level of knowledge that people have and people recognizing how important it is. So I think, which is why I've always thought that learning is very important, because people need to know how, say, climate risk in this case affects their work in both not just their personal development, but also their career development. I would find it very hard to imagine anyone in the financial institution, in any financial institution, not thinking and not knowing how climate risk impacts them, because to be fair, they wouldn't have a job maybe in the 5-7 years time, or not the job that they would want in the 5-7 years time. So I think that's a huge shift across the industry. And I think there are obviously some very obvious hygiene steps that we can take. So everything around managing our own operational carbon emissions, things that you can control around your supply chain, around how you use resources in your company and the way it operates. I mean, you try to check all these so-called basic hygiene boxes first, and then you think about your insured emissions, your investment emissions. I think investment-wise, the asset manager industry has actually set the path for us in that sense, because it's quite well articulated in terms of climate risk for asset managers. So I think in that sense it's useful. We've spoken a little bit about how for life insurance is still evolving. We're still trying to figure out how we do that. There's a lot of research that's going on. So I think it's a lot of active learning and being able to respond accordingly. But like I mentioned earlier as well, insurance is not just about climate. I mean, ESG, there's a whole social impact and all of that. So I think that goes into sort of the bread and butter of what insurers do, the protection, the having access, trying to manage that social harmony, if you like, and the balance by taking care of things when something unexpected happens. I think that's just part of our BAU. Sometimes I feel that maybe the best solutions have not been thought of yet, because we haven't been able to say, measure or model things around it. The best example, I think, is around climate change. As insurers, and you would know, Hugh, because you're an actuarial trained person, you always look at historical information, what has happened in the last 5-10 years, what patterns and models can you see? But actually with climate, it's totally the other way around. It's about seeing information that's here and now and what's looking forward. So that is something that I think we're still, everyone's trying to get a handle on.
Yeah, I was talking to someone whose background was in sort of hurricane modeling, right, and just how difficult that is, right, because you really can't rely on the past for, well, you can't rely on it now, right, and then we don't really know whether the current trends are going to be static or not. So I mean, I guess that gets to one point, you know, just as commentary, right, I suppose, around the sort of social side, which of course I think we all completely buy into. I mean, it's the reason why lots of us are in the insurance industry itself, right, but there are always these limits between what the private sector can do, what the public sector should do, and then the sort of public-private sector cooperation. And I'm starting to think, you know, so we look at, say, and this is again P&C, say parametric insurance for, say, crop insurance, which is now technically possible, right, to actually make it more convenient and easy for people to make claims in those types of scenarios. But the reality is that crop insurance is still very expensive for those people that are most impacted, and therefore the private sector can only do so much. And then you fold onto that this uncertainty with climate change, and then it becomes a topic that really you start saying, well, look, we need to have national funds in place for this kind of thing as well. And I think that's an interesting area, right, in terms of maybe some of these risks. I suppose going back to what Thomas Berber was saying, there are some risks that we underwrite now that perhaps we won't be underwriting in the future as well, maybe less so in life, hopefully, right? Because if we start seeing those risks on the life side, then things are really quite bad.
It would be quite bad. But the thing is, I mean, when you think about extreme weather events, they would have knockoff effects quite shortly on the community, on the society. I mean, think about if you had a hurricane, typhoon, extreme weather, etc. Issues around health, safety, disease, and etc. They will set in probably like week number 2 going forward. So these are very real concerns, definitely. But I think what's really important for insurers to think about is there any way we can sort of so-called take a leaf out of the book from banking? Because structuring using sort of like PPP structuring, when you think about working with development organizations like the IFC or ADB, where you sort of do blended finance, a lot of this has been done in the banking examples, particularly around infrastructure financing, where you're building very large scale, very long time horizons projects, dams, expressways, toll gates, etc. So I think these are all possibilities that I think, and there's always so-called cross-sector learning that's possible. So like I said, I think some of the best solutions and most needed solutions are probably not in the market as yet. And I think importantly as well, when technology evolves, I think that might actually change or expedite some of the changes that we want to see.
We probably don't have time to go there, but I guess alternative financing, nat cat bonds, all of that stuff as well. Let's just, and we've been rabbiting on here, right? So we're definitely up at almost at the 45 before we even realised it, but it's okay because we've got time, as we said. Just to wrap up this section, just a quick take from both of you. Do you think the 2050 goals are going to become the 2040 goals or something like that? Do you think we're going to have to revise our targets? And are things getting away with us at the moment, or do you think 2050 looks like a sustainable number 1 year?
Well, Lee, do you want to go first? I've been rattling for a bit.
Difficult to call. I mean, it's still a ways out, right? I mean, it would be great if we could. We're always shooting to be ahead of the curve, right? We don't want to wait until New Year's Eve 2049 to be scrambling, or say that we'll get it sometime in 2050. So we're always shooting to do it earlier, and hopefully we can achieve that. We're dependent on some of our business partners. We're dependent on changes in infrastructure. Hopefully that'll come to pass within the next few decades. But we're optimistic. So we're always reassessing. We have our interim goals, 2025. We expect to hit those ahead of schedule as well. And when we hit those times, it's time to reassess and see, if we can maybe extrapolate. But as Winnie said, climate change is an evolving thing, right? Who knows? We can see what happens today, but who knows what's going to happen in the next 5 years or after that.
So I think the timeline for 2050 is there for a reason, because the changes are not going to happen so quickly. There are many competing considerations, and very important competing considerations as that. But Lee mentioned about interim targets. I think that's hugely important and part of the responsibility for any financial institution in this case to be able to set them and to find ways to live up to them. Because if you think about it from a management perspective, from even a CEO perspective, for many years CEOs have been sort of living quarter to quarter based on results, reporting, and all of that. When you're thinking about something like 2050, it is not ridiculous for a CEO to say, nah, where am I going to be in 2050, right? And you could say that for all of us, right? I mean, I'm serious. Where would you, Lee, and myself be in 2050? Nobody knows. This is why interim targets are so important, because you want to hold companies to be accountable for what they sort of pledge, and to be able to say we can see the step change, or rather the steps following up to that big change that we want to happen.
Yeah, I mean, I guess I get the impression at the moment that actually there is a bit of a timetable which is quite urgent now, right? And that if we don't do, if we're still having this conversation and nothing's changed measurably in 2 or 3 years, I think we're going to be starting to feel the pressure. So I think 2050 is here actually in terms of the planning cycle. You're absolutely right as well. All right, let's get on because the clock is ticking, and I want to bring in the audience. We haven't had any questions so far, but now we're going to have a poll. So I'm going to get your views as we move into this consumer topic. So let me bring this up, and then hopefully our technology will be working with us. And let's see. So we're going to do a little poll on Zoom. So you should see coming up shortly this question, I wanted to get your views, and then we'll have a discussion around, right? As a consumer, so put yourself in the shoes of a consumer, we're all consumers, which of these best represents whether climate sustainability is a factor when you buy products and services generally? And then there's 4 answers, the sort of always, usually, sometimes, and rarely. It's an anonymous poll, and I'm hoping that whoever's controlling polls will be able to bring up the poll. Maybe I can do that. I don't know whether it's showing. That's an interesting question.
The questions are showing. I don't know if the poll results are not out yet.
No, I mean, I assume the poll is running because I can't actually see that myself, but we'll assume that it's running. It tells me here that we can't vote ourselves.
You know, we probably should have an option called "It depends." That is always the right answer.
Oh, well, you see, sometimes you've got to take a bit of a risk. So this is why we had 4 here rather than 5, to actually force everyone to take slight view on this. I mean, I don't know, you know, I'm probably a sometimes person on this one, actually, if I had an honest response, and I feel like I should be a usually person. I don't know where you guys sit on that.
I'll have to say, like from a banking background, here's what's happening. We see a lot of in private banking. We used to see a lot of companies that have family offices or foundations, and also they would be customers of a private banking business where they would be looking for a return of their money. But everyone puts on 2 different hats. When they have the hat of their family foundation or the family office, they can think about, okay, I'm happy to give up a little bit of my returns because I'm talking to you as a philanthropic slant in it. But when I think of you as an investor and you're helping me to invest my money and protect my wealth, there is very little consideration for giving up ROI in terms of financial ROI. So I think it really depends on which hat you put on, or if we are able to structure solutions that can give both, that would be good.
Yeah. Okay, great. The results here are showing. We've just had the sometimes edging out the usuallys, right? And then we've got more people on the rarely than we have on the always side. So perhaps our resolutions as a group, maybe we should try and nudge ourselves a little bit further up the equation there, so we have more of us in the usuallys, and certainly more, I guess, as we go forward in the always. But that reflects a reality, right? I think that's probably not unrepresentative of say typical consumers, right? We're sort of a little bit concerned, but are we necessarily fully changing our behaviors as consumers as well? So I guess let's explore this in terms of, there is obviously a market for funds which are completely sustainable funds, right? And people will buy into those. Where do you think your organizations are in terms of doing that sort of thing? And what else are you seeing that you think might attract the people who are in, I guess, a bit more in the always area there from a sort of financial services perspective? Maybe Lee, share your perspectives on that.
I think it's important to offer an opportunity for your customers to join you on your sustainability journey. This is something we're just kind of getting into. As of September last year, we launched a couple of investment-linked product funds that specialize specifically in either supporting companies that are making those changes or companies that are innovating in those spaces as well. So yeah, it's just a holistic way of communicating your sustainability commitments as well. You might have a divestiture or responsible investment policy, but if you're not extending that, I mean, I think it's a good policy and practice to make sure that you're offering that and paying it forward, and again, assuming your role as someone who can hook up consumers with these companies as well to provide that support.
Yeah, I think as businesses, as corporations, one of the biggest areas or levers that we can leverage on is actually our customers. How can we sort of structure products that can bring them along on the journey? So for Great Eastern, we started to launch we launched a green, what we call a green SP last year. It's a typical single premium product, but what we did last year then was to structure it so that it's backed by these renewable energy or like so-called green assets, so that it does exactly the same thing as a single premium product, but it was actually legitimately supporting these causes. Takeout was actually pretty good, but what we did not test then was if the return was not the same, would our clients be willing to do that? So I think we haven't gone down to like doing a poll as clean as that. Maybe there's room for thought for this year and future as well. But I think this is where we're also very conscious of what our consumers and customers think. So we've done a couple of series of research actually on what our consumers think. Focus groups, we've done polls, we've targeted like deep conversations with certain segments, and like the poll that Hugh has conducted is a pretty much of a bell curve, and where I think the opportunities are is how we can tap on certain segments of the extremities and maybe find a way to leverage on that critical mass sort of in the middle. But having said that, I think this is probably easier said than done. That's something that we're actively exploring.
Yeah, it's interesting, isn't it? I mean, I suppose there's also a bit of supply and demand things going on behind the scenes here, right? Because the more that we see investment in renewables and the more actually the investment fund managers say we're not going to invest in the so-called dirty industries, the more the kind of return equation actually starts moving in favor of sustainable investments as well, right? Because you've got more demand going into that area by definition as well. And I have a feeling that maybe we're reaching that tipping point a little bit now, where actually it's less about I'm having to give up a return. It could well be, look, I'm investing because this is where the money's going, right? And it makes sense to invest in these because we know that the dirty industries are not going to be looked upon favorably, and they have to manage down their growth, right? Because that's what the world needs as well. And of course, they're all busy diversifying as well, right? To become more compliant with those goals. So it's quite interesting. What else do we see? Actually, maybe because we are getting a bit short, let's go back to the skills agenda, because we kind of fell into that a little bit earlier. What do we see? Maybe a bit more specifically drilling down. What do you think? We all need to invest in to get up to speed on ESG, and how much time do you think, what's our 101, right? So if we're saying, look, I'm in the usually camp, but I know I need to know a bit more, what's my 101? How much time should I spend on this?
Lee, do you want to go first?
No, go ahead.
I was going to say that in terms of climate, science is the best foundation, actually. So that's why I was thinking whether Lee you want to go first, since you actually have an environmental science degree. To be honest, I mean, I sort of learned the trade along the way. And I think one of the biggest catalysts that sort of helped me get on this path was because I was then working in China about 10 years ago. And actually the Chinese regulator, the CBRC, was really forward looking then. They were looking at what they then called was green credit, which really means I'm looking at how climate risk was actually, or climate change was affecting the financial institution. So that was sort of how I fell into it. And I think that's what most people might do. So I think what's really important, I personally think, is number one, knowing how it impacts your job in terms of your job role, be it you are in operations, you're in risk management, you're in actuary, you're in sales, for example, knowing where the key sort of overlap it is with ESG factors and climate. I think that's number one, knowing what's important. And I think then number two is also seeing how do the regulations affect you, and number three, where can you find resources? So I think like I mentioned, there could be either there could be, like, for example, the Singapore College of Insurance, there could be like ABS for banking, there could be like your company's HR. They do have a role to play in sort of providing the resources so that you can get on board. But there is a huge difference between going for a course that says Sustainability 101 to sort of like, going into like deep diving into areas that overlap with your job and your expertise, if you like. So I think it's always good to do for a sustainability 101, but you really need to find ways that you can brush up on your specific job expertise.
Yeah. Anything to add, Lee?
I didn't want to seem biased by going first and saying science is important, because I agree it is, especially if you get these branching questions about, why are we doing this? Why is it important? What's the science behind it? But at the same time, I think, the classic rules apply. A solid foundation in things like investment and risk management. If you can put on top of that an environmental risk or climate risk lens or a modifier, like when he said, personal development is very important, and there are a bunch of resources available. In fact, that's something that our team does, is we have identified stakeholders within our organization who have significant input in our efforts to ramp up our environmental risk management. And we curate courses for them that we feel that, like mentioned, we start with a very basic 101, and then we try to find something that caters to each group. So investment, risk, underwriting, even procurement and corporate services. We'll find something that will help them understand what their role is to play and how they can proceed with that. The other thing I would mention is reporting and measurement is becoming extremely important and required as well. So I'm sure most of you have heard about the TCFD, Task Force on Climate-Related Financial Disclosures. Becoming familiar with these frameworks, and they're still evolving, but keeping on top of that and having an awareness and the information that's required under these frameworks is very important. I'd say it's very useful as well. It's going to become even more and more important and pertinent as we move forward.
Yeah, and I think it's this whole skills area. I mean, I would take a slight, not a contrarian, but I think there's those that specialize need to understand the science. Those that are the generalists need to specialize and focus on the operationalization. And I think that's equally, if not more important, right? So with the world can sometimes be full of great ideas, but if no one runs with those ideas and makes them happen, then it doesn't have an impact as well. Now, we've had one question come in a little bit late, but it is a great question. So let's have 1 minute answers on how can we avoid greenwashing in the insurance industry. So Lee, how do we avoid that?
It's tricky because people are smart nowadays. People can sense when a company is being insincere. So team building is important. Make sure that the people that are in these roles actually care about what they're doing, and make sure there's clear communication about what the target is, what you're going to be doing about it, and follow through the entire way. Be transparent about progress, and if you don't hit your targets, explain why and explain what you do next time to make it happen. But it's sincerity and honesty are a good place to start.
I think it's making sure that there's no gap in between what you're communicating and what you actually have in reality. But I think another deeper layer to that is making sure that you have the governance processes to check that your own company or your team members or other departments who are doing it, they may be a first line, second line, that they are actually doing it. So for example, if your investment team says that, oh, we are all our investment managers are a part of the PRI and they do ESG integration and I think it's also having that layer of governance to check that these are actually right. Because I think be it sustainability reporting, be it looking into definitions of what you're promising or disclosing, these are increasingly being scrutinized by regulators, of course, also in the sort of court of public opinion. But I think if we don't watch ourselves and how accurate we are, there's not just the public so-called lashback, but there's also like regulatory impact and possible litigation impact in a sense. But I personally find it quite scary because sometimes you do see greenwashing examples, particularly at a corporate level. And sometimes you feel that they may not realize that they are doing that. So I think that is quite scary, that some companies may just be saying something and not realizing the impact of that. So yes, we do have some ways to go, but it's definitely important. And then I think not just greenwashing, there are probably like 7 other shades of washing in that sense. So I think we just need to be very aware.
Yeah, good. Look, thank you. We're out of time. We definitely have had a great discussion. I hope those people who've been listening in feel it's been a worthwhile use of your time. But let me just sort of wrap up by just thanking you guys for the time for preparing for this panel. So thank you, Lee. Thank you, Winnie. And I hope everyone else enjoys the rest of the careers fair.